Welcome to the Property Profits Real Estate Podcast, the show where real estate investors talk strategy, capital, deals, and growth with your host, Dave Dubeau.
Well, hey, boys and girls, welcome back. Today, we're going to be talking about something that we've all heard about. We've heard about contrarian investing. Warren Buffett talks about this. He says, be fearful when other people are greedy and greedy when other people are fearful. But how often do we actually do that? How often does the average investor really do that? Like, we get it up here, but the difference between understanding and doing is huge. And our special guest today, Brent Guyor, knows a thing or two about that. He's a very active investor himself. They've got a company that's investing in, I believe, multifamily properties. And Brent is seeing this these days in 2026. There are tons of opportunity, but it's harder and harder to get people to invest even when they know the time is right. So Brent, welcome to the show. Great to have you.
Thank you, Dave. Great to be here. And you're 100% right. So easily said, so hard to do.
Well, I have a hard time myself sometimes, man. It's just like human psychology is so interesting. But before we go down that rabbit hole, Brent, tell us a little bit about you, your company, what you guys do.
I'm Brent Guyor. I'm the CEO of Ironton Capital. Ironton Capital is a private equity firm specializing in accredited investors. And we have a couple of different funds. The equity side, our specialty is pooling accredited investors and allowing that pool to have the bigger negotiation power to get into larger projects and diversify among several projects. So, quick example, if you're a landlord exiting, you've got $200,000, you can maybe stick it in one project if the minimums are that low, and then hope that project works out. Or you can place it in one of our national diversified funds, get 10 to 12, and you have a much better shot or a much more predictable return of what you're going to get.
And so much lower risk, right? Exactly.
100%. So that was the first product we couldn't find, so we brought that to the market. And then we also have two income funds. One's a short-term income backed by hard money loans. That's more of a standard product. The second one's a unique product. It's a medium-term income backed by medical receivables. That's a one-year lockup, and it pays 11 to 13% on average 12.1. We pay out quarterly. So again, if you're on the average of 12.1, you're basically getting 1%, 3% every quarter. That's a nice little check to get. So those are the funds that Ironton offers. And again, my background is accounting and real estate, as you might imagine. That's how you end up as the CEO of a private equity firm specializing in real estate and such things.
Okay, so you talked real fast there, Brent. I got most of it, but let's break it down. What are the actual asset classes you guys are pooling funds to buy?
We are actively invested in hard money loans, medical receivables, and then on the real estate side, we get into a diversification. And generally that diversification is multifamily, both value add or new build. And we will also do industrial, particularly infill industrial. Love it. We will do extended stay hotel. Mm-hmm. Again, I it's not that I don't like the newer hotels and some of the stuff, but I can't, as a fiduciary, can't promise when I get you in or out. That's also some of my aversion to retail and 100% my aversion to any kind of office. I can't touch office as a fiduciary right now. There's even though the contrarian investor in me wants to go to office, as a fiduciary, I can't recommend it because I can't tell you reliable exit strategy or timeline.
Okay. Yeah, I know. That makes sense. All right. So let's talk a little bit about the whole contrarian thing and what you're seeing. That's what we let off with. So tell me your version of contrarian investing and explain to me a little bit about the reactions you are getting from people when you're explaining this to them these days.
100%. So again, mine is the Buffett, is the Rockefeller. I fear when others are buying, and any of those. The statements and the theology on this goes way back. So easier said than done. What we get is right now we're trying to raise for both real estate and the income funds that I've just mentioned, and it's overwhelming how much of our fundraise is going to income funds right now. And the income fund's a fixed return. It'll still be around, next year, the year after. the real buys right now are on real estate. Real estate's been beat up for 2 or 3 years now. You have to understand when you're going in, it's probably a 5-year cycle. If business on average is a 7-year cycle, we should be coming out in 2 to 3. I think this is an extended cycle because we went in with a little bit of an extended cycle. And again, none of us are seeing going, oh yeah, we're coming out next year. If any of us, are you predicting next quarter? I'm not predicting that we turn around next quarter.
You're smarter than I am. You're more of a numbers guy, and my crystal ball sucks. So no, I try not to make predictions like that for sure.
Boy, you're stealing my lines on the crystal ball.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com.
So 100%, it's probably going to be a little bit of an extended downturn this time out, and or the recovery will not be like what we saw in 2013, 14, 15, where we took off like a rocket ship again. I don't think there's any chance of that. I think our recovery will be much more slow, especially on the real estate side and pronounced. Stocks may be slightly different because they look like they're ready to explode as soon as we can figure out a few things otherwise. Again, but you need all of it to have the blended portfolio. On the real estate side, it's as good a time to buy it as ever.
So when you're talking to somebody that's not as tuned into real estate as you are, how do you explain the situation to them in plain English?
This is, if I had that silver bullet, man, our fundraise on the real estate side would be.
Okay, how do you try to explain it to them? How do you try to explain it to them in like the layman's terms?
Again, what I try to explain is you want to move opposite of what everyone else has done. And what I've done myself is an 8, 9, 10 in the Denver real estate market, because again, we were the canary in the coal mine for that downturn. And our, inventory went through the roof as far as what supply for on MLS and everything.
So you're talking about single family homes back in the day, correct?
Single family and attached.
Yeah.
I went in and it just went. I was like Eddie Murphy and Dan Aykroyd in Trading Places. Buy. It was so obvious because our population at the same time was going up. People needed a place to stay. These were good places.
Mm-hmm.
So again, but it was at the time hard to tell people about.
Yeah.
And again, at the time, even some of my neighbors who will go unmentioned, who worked for other realtor companies, also going unmentioned, told me I was going to go bankrupt. Why would you buy now? This isn't a free fall. And I'm looking at prices going, I'm buying it like same thing it sold for 92. And guess what? When it comes back, do people go, oh, you bought it 92 prices, so I'm going to give you this much appreciation? No, they gave me all the way to the 2020 appreciation level.
Yeah, exactly.
So you have to kind of, the best way that I can do is go back to those examples. Everyone thought I was crazy in 2008, 9, and 10, and that's where I made a outsized return to what I should have made otherwise.
Mm-hmm. So you're saying basically we're on this cusp of something maybe not that spectacular, but along those lines in multifamily.
Again, we're not. Cusp is such a laced word, right? Because again, I don't know that we're right on the precipice, but I know this: don't spend all your chips now, but don't take all your chips off the table. Buy all the way through the downturn, because I don't know which quarter is the downturn. You don't know which quarter is the downturn. We already covered that a few minutes ago. Yeah. So again, I didn't buy just in 08. I started buying 08. I bought all the way through like 13 or 14. And then my naive self said, wow, look how fast everything's coming back. And if you remember, there's shadow market inventory. So I turned off my acquisitions. In hindsight, one of the dumber things I've ever done. I should have kept buying right through. There was no shadow market inventory. All that never proved out to be true. I bought into a little bit, and because I was risk adverse, just kind of didn't turn everything off. It turned everything way down. Again, but I was the contrarian guy, because now everyone's flooding in, and I'm going, whoa, this is a little crazy, and I pull back. So at least I'm holding true to who I am as an investor.
Right. Yeah. So
know,
that's what you're trying to explain to people these days. Why do you think it is that it's just so difficult for the average person to really take action on that advice? Why do we have so much of a herd mentality?
Well, I mean, herd mentality is such a great way to put it, because we never want to do, much worse than our neighbors. We're trying to do much better than our neighbors, but we never want to do much worse. And we get a lot of opinion and stuff from our neighbors in the pool or in the grocery store line or wherever you may run into them. And we get a lot of media influence. And again, there's nothing wrong with me. I have no bias against the media, but the media is typically reporting stuff that is anywhere between 30 and 60 days late at the best. Sometimes they're 6 months behind on trends and stuff like that, because they're reporting on what's happened. Right. If you're kind of in the market, if you got a kind of pulse on it. Again, we kind of have fun with these and kind of go, boy, does today feel like a bottom day? Could be a bottom day. And we'll kind of mark it on the calendar, and then we'll get 30, 60 days out and see if we're anywhere close, or if we're still kind of going along like this. Like carp along the bottom of the shore. Again, we kind of have that fun with it. You got to kind of have fun with it, but you got to be in the know. The average guy isn't doing that. They aren't kind of going, hey, do I feel like a bottom, and marking their calendar. They're influenced by their neighbors. They're influenced by the media. And then
they don't have their thumb on the pulse at all like that.
100%. And then they run into a guy like me in the grocery store on Sunday morning. And as you started out with it, boy, you said a lot real fast. I'm sorry, that's my nature. They pay me by the idea, not the minute. So we kind of roll things. We roll things as quick as we can. So again, I can be a little bit much, as you can say. But when I stop and try to break it down, a lot of times I actually can get through to some people. We do get the guys who are going contrarian. And I think the guys who are coming into our real estate funds right now are going to crush it. Mm-hmm. And again, is it the fund this year? Is the fund next year? I'm not sure. I'm going to put money into both.
Mm-hmm. So I was going to ask, so changing gears a little bit here. So you guys are real estate guys, but one of your funds has medical receivables? Is that what you said? So tell me a little bit about that. How did you clue into that as an investment opportunity, and how'd you go from real estate to buying medical receivables?
Again, we were looking when we started Ironton to kind of have a balanced portfolio. And so the short-term income and the real estate were real obvious. They're in the real estate portfolio, hard money loans and the diversified real estate investments, easy for us to come by. We were trying to fill that middle kind of gap, if you will. And we looked at several different things. I can't name them all, in the essence of time, but many, many different things. And again, reliability, consistency, all the things that we need as fiduciaries to be able to recommend. Well,
maybe zoom out for a second, Brent. Just explain what it is. What is a medical receivable, and how does it work? Just so we really understand what this thing is.
Easily done. What it is at the base is the same as account receivable factoring applied to the medical world.
So again, for people that aren't familiar with that, what does that mean?
Like you're buying accounts receivable from a company that needs immediate cash. So the particular company that we are working with goes to mid-tier hospitals in no-fault states, in no-fault the insurance term, and buys their medical receivables. Like, say you and I get in a car accident and I break my leg at $10,000 or $12,000, whatever it costs to fix that. It's not worth the hospital's time to go collect that. They have nurses to pay. They have utility bills to pay. They need to keep their facility running. So
right. They billed you $12,000, or your insurance company $12,000 for fixing your leg. You're not cutting a check for $12,000 today. Insurance company is, net payable as long out into the future as humanly possible, I'm sure. So the hospital wants to get paid faster. Is that the nuts?
Exactly right.
Got it. All right. Okay, keep going. Sorry.
This company then goes to that hospital, buys the note, or they'll either do one of two things. They'll either buy it outright or they'll lend against it. Typically, either way is about 30 cents on the dollar. So their margins are quite high.
So for that, so the hospital is actually taking $3 or $4 for that $12,000 bill. Is that what I'm understanding?
Yeah, it's exactly right.
Wow.
Yeah.
I had no idea it was
but
that
then the sponsor that we work with has a whole team specialized that knows exactly. So if you're with, again, we'll just use as example State Farm, and maybe State Farm's form is SF001. They know to use that. I may be with Allstate as another brand a lot of people would know, AL22574. They know that form. They know exactly how to work these processes as fast as humanly possible. And again, we're working with insurance companies here, so let's keep our expectations. But they have the ability to go and collect on these in a very reasonable time frame, and then the company churns that cash as fast as possible. So as soon as they collect on my claim, they reinvest it now in the next car accident claim, which may be your neighbor.
Or 3 more car accident claims, right? That's
exactly right. So they generate as fast as possible. So then what we do is basically we agree to lock it up, and we get paid out 4 times a year, once a quarter, generally right around 20 days after the quarter. And otherwise, the cash is going like this and churning as fast as possible.
So are you guys doing the collections, or are you investing in a company that does the collections?
We're investing in a company that does the collections. Ironton is always a fund of funds. Yeah. We never do these things directly ourselves. We go out and find them, negotiate it, with the volume, and then bring that to the masses.
Interesting.
So, and in this case, the sponsor, we caught them at the perfect time on the way up. They had $1.5 billion of assets under management when we negotiated our deal. They now have, I think, almost $5 billion under management now. So could I go back and negotiate the same sweetheart deal? No, I couldn't. Do I still have space available in my fund? Yes, I do. So again, do I have an income fund at the time when income funds are in fashion, not the contrarian thing? Absolutely.
So you got kind of different flavors for different folks in different states, but I get it. Okay, well, hey, Brent, time flies when we're having fun here, my friend. So thank you very much for kind of explaining your contrarian view on things. Thank you very much for explaining the medical factoring business as well. That's I had no idea it was those kind of differences. That's amazing. If people want to connect with you and find out more, where should they go?
www.irontoncapital.com.
There you go. Brent, thanks for being on the show.
Thank you so much, Dave. Pleasure to be here.
Thanks for listening to the Property Profits Podcast. If you'd like to be a guest on the show, apply at daveinterviews.com.